Hello, it's a lovely good evening once again from here and hope that each one of you are absolutely fine. So now coming to the business end, in this particular session we are going to start a very formidable chapter, AS14, Amalgamation of Companies. Now even though the name of the chapter happens to be Amalgamation of the Company, in order to have a complete and comprehensive command over this particular chapter, we need to actually acclimatize ourselves with three important terminologies. One, amalgamation of company, and second, we will see absorption of company, and third, external reconstruction. These are the three terms which are going to play a very pivotal role in what we call understanding this particular chapter. As I've already told you, it's a pretty strong chapter, formidable one, and a little bit longer also at the same time. Now, amalgamation of company. First of all, let us analyze what we mean by amalgamation of companies. Correct? In order to understand the meaning of amalgamation of company, let us presume that in the market there are two big companies, X Limited and Y Limited. X Limited and Y Limited. Correct? For a while, you further presume that both these companies are engaged in the same line of trade. Let us say both these companies are manufacturing computers or laptops or whatever it is. That means they are in the same line of the trade. So X Limited and Y Limited had decided that why not we should actually merge together and form a one single unit. Let us say they have decided to merge and form a one single unit by the name of XY Limited. From the accounting perspective, you need to understand that even though X Limited and Y Limited themselves have decided that now we are going to actually combine together and form a one single unit, correct? They themselves have decided, of course it is known as amalgamation of companies. Amalgamation itself means to combine, correct? To merge together. So X and Y Limited have merged and they have formed a new company. However, from the accounting perspective, you need to understand that, and this is very important, the XY Limited will be considered as purchasing company. It will be known as purchasing company. Why it will be known as purchasing company, I will let you know in a short while. So XY Limited will be considered as purchasing company. However, X Limited and Y Limited, both these entities will be considered as vendor company. Vendor company. In accounts, we use word vendor for the seller. Vendor companies. Now try to understand actually why XY Limited is considered as purchasing company and why these two companies will be considered as vendor company. The reason being is that under amalgamation of companies, which is covered by AS14, quite obviously it also means that while doing the amalgamation of companies, concurrently we are going to do accounting standard AS14 too. Correct? Now, under amalgamation of companies, in order to do the accounting, we have to break up the scenario into two important parts. The selling company, known as vendor company, or purchasing company. Into two important segments, we have to divide the entire scenario. Now here we are dealing with this scenario of amalgamation of companies. Now amalgamation of company, put it in simple words, means when two or more than two entities combine together to form a new entity, that is simply known as amalgamation of company. However, from the accounting perspective, the newly formed company is known as XY Limited, and it is so because now we will presume that XY Limited has taken over the business of X Limited and XY Limited has taken over the business of Y Limited. In order to do the accounting, you will have to analyze the entire situation in this manner. Because XY Limited is taking over business of Y Limited and business of X Limited, we can also say that X Limited is selling its business to XY Limited or Y Limited is selling its business to XY Limited. That is why X and Y Limited will be known as selling companies or vendor companies. Is it clear to you or not? Second important point which you need to understand regarding amalgamation of companies is that amalgamation of companies in practical life generally takes place between such companies which are generally in the same line of trade. As I told you in the beginning itself, that both these companies are, let us say, into same line of trade. Let us say manufacturing of computers, or let us say manufacturing of laptops. So in practical life, we see that amalgamation generally takes place between big corporates and generally who are engaged in the same line of trade. And why generally amalgamation is done? or amalgamation is adopted by big corporates because it brings about some important mileages and advantages. And the one prominent advantage is that they almost will get a sort of monopoly in the market. Correct? When two big corporates will combine together and join hands and form a one single unit, quite obviously they will be in a better position to control the market. Second, it will also help, as you have studied in your economics, that it is going to bring them what we call economies of large scale production. We know that when we produce goods on a large scale, our cost of production will come down. So these are the sort of advantages. So that is the reason in practical life we often see that corporates merge together. Correct? I hope you got a fair bit of idea now what we mean by amalgamation of companies. So here you write in a little bit along with me. So amalgamation of company, as I told you, generally amalgamation of companies simply means merging of two or more than two entities, into a one single unit, So as we have seen here, X and Y Limited, they merged and form a new entity, one single entity, that is XY Limited. Correct? As a moment ago, I told you that generally amalgamation takes place between companies or corporates who engage in the same line of trade. So if you want to write, you can write that also. Amalgamation generally takes place between or among companies engaged in the same line of trade. In the same line of trade. In the same line of trade means, as I told you, they are engaged, they are involved in the production of almost similar goods, correct? Further, I told you actually why amalgamation is done, why corporates actually merge together, correct? Amalgamation is resorted to derive following advantages or following mileages. So why in practical life actually corporates amalgamate? Because it brings about some advantages, as I told you. One advantage is, the first and prominent advantage is that it will give them a very good control of the market share. That means they will almost acquire a sort of monopoly in the market. Correct? So, amalgamation is resorted to derive the following advantages. That is, monopoly elements. Monopoly elements means, you understand better than I actually in this particular case, that means they will have almost what we call uncompetitive share in the market. There will be hardly any rival, correct? Suppresses the competition. Suppress, S-U-P-P, suppress the competition. And this is similar to monopoly elements. Quite obviously, when two big or more than or let us say 3-4 big corporate enterprises are going to join hands, quite obviously they are going to kill the competition. They are going to suppress and wipe out the competition. Suppresses the competition. Isn't it or not? And economies of large scale production. Economies of large scale production. Economies of large scale production, quite obviously, because now they are going to produce on a mass scale and it is going to actually reduce their cost of production. So economies of large scale of production. Large scale of production. Large scale of production. So these are some important and chief advantages of amalgamation. And that is the reason why in practical life we see that corporates day in day out are actually merging together. At this particular level, you are going to study only the merger, that is amalgamation of companies. But when you will move into higher levels, we'll talk about demergers also. So day in, day out, we see actually mergers, demergers, splits off and so many things. But here we are dealing up with amalgamation. Now I hope you got the meaning of amalgamation. Correct? So amalgamation of companies simply means when two or more than two entities combine together and form a new entity. This is simple to understand. However, from the accounting perspective, how you are going to analyze that is also very important. So newly formed company will be termed as purchasing company, while the existing company who are merging will be considered as selling their businesses. Correct? So they are known as liquidating company or vendor company or selling company. Is it clear to you? Now, second important term to get control of this particular chapter, second important term is absorption of company, which you need to understand. What we mean by absorption? Absorption of companies. Absorption of companies. So absorption of companies is also very vital. Absorption of companies. What we mean by absorption of company, try to understand it in this manner. Correct? Let us say there is a very small company. Correct? This is a small company by the name of S Limited. And there is a big company, let us say, by the name of B Limited. For a while, just presume that both these entities are in the same line of trade. Just presume for a while, there is no harm in it. Correct? Let us say both these companies are absolutely in the same line of trade. Now, what is happening? Because of its size, the small company's financial strength will be quite obviously lower than this big company, no doubt about that. So howsoever they may spend on the advertising or to enhance their market share, perhaps they may not be as successful because their financial strength is comparatively lower than this big particular company. Correct? So sometimes the smaller company thinks that rather than what we call running the show by themselves, it is better to join hands with the big company, because sometimes a small company may feel that in spite of their best efforts, they won't be able to match their wits against the big company. So that is the reason sooner or later the small company may feel that we may not be able to compete with the big company and we may lose the race in the long run. So it is better to get yourself merged into the big company or simply allow the big company to take over you. This is known as absorption of company. Suppose in this case, a B company says to S Limited, why you are running the show unnecessarily, because in the long run you won't be able to compete with us. So that is better. What you do now, you simply become a part of what we call our structure. In this case, from the accounting perspective, we may say that this big company has taken over what we call S Limited, and it will be known as absorption. Is it clear to you or not? So absorption in simple words means in practical life when an existing entity, of course, of higher financial strength will take over another existing company and obviously of lower financial strength, then it is known as absorption of companies. Is it clear to you or not? Now, in practical life actually, why there is need for absorption? Why big company would like to take over this small company? Why not they let the small company to run the show and part of the competition? The reason being is that actually when a big company takes over the small company, or whenever an entity takes over another entity, actually indirectly it releases a sound statement of their financial creditability in the market. For example, some time back, when Tata Motors actually absorbed Jaguar of UK, correct? Jaguar, I'm talking about a very big company of UK and considered as very elite company. So, if Tata has taken over Jaguar, then very next day there was headlines in the what we call prominent newspapers of the world. So that sent a message in the market that Tata Group is a very strong, financially viable group. So whenever an entity takes over or absorbs the other company, that doesn't mean that it is going to bring them profit ultimately. For example, initially when Tata took over Jaguar company, Tata actually went into losses in the initial years. But that enhanced their financial credibility by leaps and bounds. And that is the reason actually why in practical life, day in, day out, we come across what we call such situation where we see actually that companies are absorbing the other companies. Is it clear to you? That is what we mean by absorption of companies. So absorption of companies simply means, right in this manner, when an existing company, right in bracket, generally of higher financial strength, higher financial strength, So when an existing company, which happens to be generally of higher financial strength, takes over another existing company, right in bracket, of lower financial strength, So when an existing company takes over the business of another existing company, then it is known as a case of absorption. So then it becomes a case of absorption. Is it clear to you? I told you why actually entity take over the business of the other entity. Correct? Generally, absorption is resorted to make a sound financial statement of financial credibility. So it enhances the financial credibility of the company which takes over the business. Now, try to understand this point. When A Limited took over the business of S Limited, obviously it will become a case of absorption. Now, in this case, S Limited will be considered as vendor company, while Big Limited, which is taking over the business, will be considered as purchasing company. Is it clear to you or not? Yes, sir. Absolutely clear. Now we come over to next point, known as external reconstruction. External reconstruction. There is another term, internal reconstruction, but that we are going to study as a separate chapter later on. External reconstruction. What we mean by external reconstruction? In order to make you understand the concept of external reconstruction, way back, there was a company by the name of Forenz, correct? Way back, there was a company by the name of Forenz, and it used to produce toothpaste, and a very famous company it was, correct? I'm talking about 40s and 50s. So perhaps your grandfather might be aware of this. So there was a company by the name of Forenz, as I told you, and it was a very popular company, very big company, and it had a great reputation. And remember one thing, at that time there was hardly any other product. There were hardly competitive products also. So it was unchallenging almost in the market. But suddenly in 70s, 80s, what happened actually, it started incurring losses. It started incurring losses because some new products entered into the market and they started giving stiff competition to Forenz Limited. So what Forenz Limited did actually, the Forenz Limited liquidated itself. It closed down, correct? It liquidated itself, but it re-emerged as a new entity by the name of Binaka Limited. So what we mean by external reconstruction? External reconstruction means self-liquidation by a company and self-liquidation by an entity and re-emergence as a new entity. That is known as external reconstruction. That means first we are going to liquidate ourselves and then we are going to re-emerge as a new entity. Correct? So that is known as external reconstruction. So Forenz Limited, what it did actually, let me, if you allow me to continue with this particular story. So Forenz Limited, as I told you, who was running the show in 40s, 50s, suddenly found a stiff competition in 60s, 70s and started incurring losses. So it thought that better now, perhaps our name is no more bringing us or fetching us enough returns. So better now to liquidate yourself and re-emerged as a new entity. So it re-emerged as a Binaka Limited as a new entity. Now, because the product was really good and within a very quick time, it is able to recap the market. It is able to what we call recapture the market. So Binaka Limited started ruling the roost almost in 70s and 80s. However, then suddenly the market changed and there were many other products in the market. Again, Binaka Limited decided that enough is enough. We are not in a position to bear the losses. So again, it liquidated itself. and it re-emerged as a new entity by the name of Sibaka Limited. By the name of Sibaka Limited. However, Sibaka Limited could not sustain the market, correct? As I told you, now the competition had become very, very what we call stiff, tough, and it was very hard to survive the market because of onslaught of several products. Colgate was ruling the roost now, and besides there were Pesponent and many new products. I mean to say, so Sibaka Limited could not capture the lost glory. So ultimately, the directors of this company decided that we should again liquidate, and this time they re-emerged by the name of Forens Limited. Now, if we will go to any medical shop and if we'll ask for Forens toothpaste, because it is considered as very good for your gums, and generally people of old age prefer this particular product. Still, it is a really good product without a doubt, but it is not having the same sort of market as you know. So, but now again they, as we call it in English, again they came back to the square one position. So that is what we mean by external reconstruction. So external reconstruction simply means self-liquidation, by an entity and re-emergence as a new entity. When Forens decided that it will liquidate and form a new entity, from the accounting perspective, we will say that Binaka Limited is purchasing company and Forens Limited is vendor company. And when Binaka Limited decided to liquidate and form a new entity, now Binaka Limited will become vendor company and Sibaka Limited will be considered as purchasing company. I hope you got the meaning. Similarly, when Sibaka Limited decided, correct, to liquidate and form a new company, Forens Limited, now Sibaka Limited will be considered as vendor company and Forens Limited will be considered as purchasing company. So these are the important terms, first of all, which you need to understand as far as this particular chapter is concerned. You must have also noticed during this entire what we call discussion that whatever may be the situation, whether of amalgamation or of absorption or of what we call external reconstruction, there is always a purchasing company and there is always a vendor company. Correct? You must have noticed, because in amalgamation we saw there were two vendor company and one purchasing company, while in other two cases we saw there is a purchasing company and vendor company. So in all the three cases we have seen that there is a purchasing company and there is a vendor company. Quite obviously, when in this particular chapter we will see amalgamation of company, whatever may be the scenario, whether amalgamation or absorption or external reconstruction, we will always notice and we will always see that there will be a purchasing company and there will be a vendor company. Number one, if there will be a purchasing company and vendor company, quite obviously then our accounting will span only in these two sets of books. Correct? In the books of, we will do the accounting in the books of vendor company and we will do the accounting in the books of purchasing company. It is as simple as that. Is it clear to you or not? So the next point is that we will now try to understand the accounting aspects as far as this particular chapter is concerned. So, two, accounting aspects. Just a moment, I told you, as far as accounting aspects are concerned, accounting aspects will run what we call into two sets of books. Entire accounting will be done in the two sets of books. What happened? Just, it seems. So as far as accounting aspects are concerned, entire accounting will span into two sets of books. Because whatever may be the case, there will be either a vendor company or a purchasing company. So accounting will be, as I told you, will be done in the books of vendor company and in the books of purchasing company. Correct? In the books of purchasing company. We will see later on that purchasing company is also known as transferee company and vendor company is also known as transferor company. But these two terms I will use in detail when I will actually make you understand the accounting in the books of purchasing company. Right now, you should be actually only bothered about vendor company and purchasing company. These two words are enough to comprehend the what we call accounting aspects. Correct? Since accounting will stretch, as I told you, in the books of vendor company and purchasing company, now we need to acclimatize ourselves how the accounting aspects will unfold when we will do the accounting in the books of the vendor company. Vendor company is one whose business is now closed. It is also known as liquidating company. Correct? It is also known as selling company. It is also known as vendor company. Correct? So now here I will write 2.1. Now 2.1 means this is the section we are analyzing, and we are analyzing what we call now accounting aspects in the books of vendor company. So books of vendor company. Books of vendor company. Because the business of vendor company will get closed. Correct? It is as simple as that. Suppose if other company will take over my business, quite obviously my business will be closed and liquidated. So first of all, you need to understand. Do you remember you have done in your earlier phases of education so many times a chapter by the name of dissolution or partnership? Correct? If you remember that particular chapter and if you can recap what you used to do in that particular chapter, it will help you a lot actually in doing the accounting in the books of vendor company. The only difference is that instead of a partnership business, here a company is getting liquidated. A company is getting liquidated, its business is getting closed. Now, when the business of an entity in accounts gets closed, as you remember actually, we prepare generally a realization account as you used to prepare in your dissolution of partnership, if you remember. Then besides that, you used to prepare the owner's account. Because in partnership, owners were capital, so you used to prepare partner's capital account. And the owners of a company are shareholders. So here, the vendor company, besides preparing the realization account, will prepare shareholders account. It is similar to that. Now, in your dissolution of partnership, you used to prepare cash account or bank account, whatever it is. So similarly here you are going to prepare cash and bank account. So that means if you can recap, as I told you, the accounting which you did under dissolution of partnership, that will help you a lot in comprehending the accounting in the books of vendor company. To be very honest, it is almost similar to that. But let me actually just explain it in detail a bit. Now, as far as books of vendor company are concerned, the vendor company is going to actually prepare, in fact, open not 3 but 4 accounts. Correct? So, books of vendor company. Vendor company will open, vendor company shall open following accounts. Vendor company shall open following accounts. Now, what are the accounts? That is A, realization account, as I told you. Vendor company will open a realization account. B, it will open, as I told you, shareholders account, because shareholders are the owners. Shareholders account. Under dissolution of partnership, you used to open partners capital account. So instead of partners capital account, here we are going to open shareholders account. Now, Over there you used to prepare cash or bank account, and similarly we are going to prepare here cash and bank account. However, one extra account I will prepare over here. That is because under dissolution, our partnership used to get closed. No other entity was purchasing our business, if you remember. However, in this case, the other entity is taking over our business. That means there is some other entity also. So we will have to prepare the other entity account, and better known as purchasing company account. So you will, in the books of vendor, besides these three accounts, you are going to open purchasing company account also. Purchasing company account. Purchasing company account. Correct? You are going to open purchasing company account. Now, you presume you are the vendor company, you are the accountant of the vendor company, and the business of your entity has closed down, and you have opened these accounts. Now, quite obviously, in order to prepare these accounts, you need to know how the accounting will be done. Under the first step, what you are going to do, first step. Now, first step deals with closure of asset side. That is closure of asset side. Closure of asset side. So first of all, we need to close our asset side as you used to do in your partnership, dissolution of partnership. Correct? So in order to close the asset side, what we are going to do, we need to understand that. In order to close the asset side, first of all, what I am going to do, I will transfer all the assets to the debit side of realization account. That should be my first point, correct? Transfer all assets to the debit side of what? To the debit side of realization account. To the debit side of realization account. In short, I have written REL, realization account. All the assets. However, we need to exercise caution with respect to one asset, that is cash and bank. In dissolution of partnership, what you used to do, you used to transfer the balance of cash and bank to the cash account or bank account. Correct? In your dissolution of partnership, in your earlier phases of education, what you used to do? You simply used to transfer the cash and bank balance to the cash or bank account. But here you have to exercise caution. Why I am saying so? If cash and bank balance are being taken over by the other entity, because here the new situation is that there is other entity also. If other entity is taking over my cash and bank balance, then if cash bank is taken over, T/O means taken over by new company, it means to say, or by purchasing company. So if cash or bank is taken over, then we are going to transfer it to the debit side of realization account. So if cash and bank is taken over by the purchasing entity, then in that case I am going to transfer it to realization account. However, if cash and bank balance is not taken over, if it is not taken over, because it may be a possibility that purchasing company may not take over our cash and bank balance. So if not taken over, then we are going to transfer to the cash account. However, besides cash, whatever assets are there, whether those assets have been taken over or not, whether those assets have been taken over or not, you are going to transfer them to the debit side of realization account. Transfer all asset to the debit side of realization account. I will also write here, irrespective of the fact, irrespective of the fact whether taken over or not. Whether taken over or not. So all other assets, plant, machinery, building, debtors, stock, inventories, whatever, correct? All other assets, whether taken over or not, blindly you are going to put them to the debit side of realization account, correct? So, irrespective of the fact whether taken over or not. However, with respect to cash, you will have to exercise the caution. Now, the point here is that in asset side, there are some assets. Actually, they are not considered as real asset. What asset means? Asset means an account having debit balance and which is capable of fetching us some returns. Correct? In simple language, if I will use the language of accounting framework, then perhaps you may get a little bit confused. Actually, accounting framework says an asset means a resource which is controlled by an enterprise and which is capable of fetching you return. That is what we mean by assets. However, on the asset side, we may come across some items which are not in real terms as assets, correct? They are mere debit balances, but they are not what we call assets. For simplicity's sake, we will call them valueless assets. That means on the asset side, if there will be some valueless asset, there is no legal jargon. It is just for what we call simplicity's sake, I am telling you valueless asset. Now, valueless assets like profit or loss account debit balance, P&L debit balance, like your underwriting commission, preliminary expenses, PE, preliminary expenses, any suspense account, Now, if you come across any such asset towards the asset side, simply consider them as valueless asset. Why? Because they are not having any value. In fact, they are not going to fetch you any return. Now you let me, being the owner of the business, it is your duty to bear the what we call not only profits but losses also. Correct? If profit belongs to you, then losses also belongs to you. So generally the purchasing company will not take over our valueless assets. Valueless assets will never be taken over. So that is the reason all the valueless assets, whatever are there, will be transferred. So all these valueless assets shall be transferred to the debit side of the shareholders account. Transferred to the debit side of shareholders account. In short, I have written SH account, shareholders account. Why we are going to transfer them? Because it is the duty of the shareholder to bear the losses. So besides valueless assets and cash, all the assets will be transferred whether taken over or not. All the assets, plant, machinery, building, correct? Furniture, fixtures, similarly debtors, bills receivable, similarly patent, goodwill, trademark, all the assets will be transferred to the debit side of realization account whether taken over or not. However, just one item will require a little bit of caution, that is cash. Is it clear to you? So regarding cash, you have to be a little bit careful. If it is taken over, you are going to transfer it to the debit side of realization account, and if it is not taken over, then you are not going to transfer it to the debit side of realization account. Then you will transfer it to the debit side of cash bank account. So our first step will be to close the what we call our asset side. Now, we will move over to the next step, that is second step, closure of liability side. Closure of liability side. Closure of liability side. As far as liability side is concerned, correct? As far as liability side is concerned, let me tell you, entire liability side can be divided into some important headings, correct? Entire liability can be divided into some important headings. Let us say, in the liability side, obviously, because we are dealing with liability side, but in the liability side, every item is not a liability, as we know. So, in the liability side, if there are liability, what we mean by liability? First of all, you need to understand this. What we mean by liabilities. First of all, you need to understand that in business, there are three parties. Always in accounts, there are always, whenever you do the accounting, you need to understand this particular fact that, or this particular mantra, as I would call it, you need to actually understand that there are always three parties. The first party is considered as business. First party is business. Second party is owner. These two parties are also known as internal parties, correct? Internal parties. And all the other parties other than business and the owners are known as third parties. All supplier, creditors, debtors, customers, clients, correct? All these are third party. So first of all, you need to understand that in business there are actually three types of parties. Broadly speaking, there are two types of parties, internal parties or outside parties. So whatever amount is due by your business to the third parties, correct? Whatever amount which we owe to the third parties is in real terms known as liability. Is it clear to you or not? So now I will make you understand that all the liabilities, whatever liabilities are there, all the liabilities will be transferred to the credit side, transferred to the credit side, to the credit side, to the credit side of realization account, to the credit side of realization account. Is it clear to you? To the credit side of realization account, whether taken over or not. Whether taken over or not. So, all the third party liability as we call, because liability itself means amount due to the third parties. So, whatever amount is due to the third party, that is known as liability, and all the liability will be transferred to the credit side of realization account, whether taken over or not. Now, what are actually our liabilities? And mostly you are well aware of all this. There is no point in writing all these things, but still I will write it for you. For example, sundry creditors. In your notes, I have written the full forms, correct? Bills payable. These are liabilities, sundry creditors, bills payable, outstanding expenses. All these are our liabilities. So, sundry creditor, bills payable, outstanding expenses, provision for tax. Of course, debentures, if there is any. Workmen profit sharing fund. You need to be workmen. This is interesting item. Workmen profit sharing fund. It is liability. Workmen profit sharing fund. It is considered as liability. It is not a fund. Workman's saving bank account, because these two liability confuse a lot. Workman saving bank account. Saving bank account. Correct? I have given you a bit of list. So all the liability, important point is that all the liability you are going to transfer to the credit side of realization account, whether taken over or not. Now, besides liability, just wait. Now, besides liability, there will be some reserves towards the liability side. There will be some reserves towards the liability side. Now, reserves can also be categorized into, just pay attention here. As far as reserves are concerned, obviously reserves are not liability, number one. However, reserves can be categorized into three parts, as I told you. One, that is specific reserves. Specific reserves. Now, what we mean by specific reserves? Correct? Name itself is telling you that specific reserves are those reserves which are specifically, particularly created for a particular purpose. In fact, all the specific reserves are nothing but provisions. All the provisions which you make in accounts are nothing but specific reserves, because they are created for some specific purpose. For example, provision for doubtful debts. Provision for doubtful debts. For example, provision for depreciation. Provision for depreciation. Similarly, stock reserve. So if you come across such items in the balance sheet, these will be considered as specific reserves. And all these specific reserves are also transferred to the credit side. Transferred to the credit side of realization account. Transferred to the credit side of the realization account. Credit side of realization account. You are going to transfer it to the credit side of realization account. Remember one thing. Is it clear to you or not? You are going to transfer them to the credit side of realization account. However, remember one thing. Purchasing company can take over only assets which are in real sense assets, correct, and liabilities only. Purchasing company will never ever take over your reserves. But you need to understand that a specific reserve will be transferred to the credit side of realization account. Besides the specific reserves, we may come across other type of reserves are known as free reserves. Free reserves. And all the free reserves, correct? All the free reserves. Like, now you may ask me, so please provide a list of free reserves like general reserve, like profit and loss account, correct? Like security premium if there is any in the balance sheet. Similarly, capital reserve. So whatever type of reserves, I have made an exhaustive list in your notes, correct? So all the free reserves will be transferred to the credit side, of shareholders account. To the credit side of shareholders account. Credit side of shareholders account. Correct? Why? Because these are sort of accumulated profits. So it will be posted to the credit side of the shareholders account. Correct? And secondly, as far as reserves are concerned, the third category is statutory reserves. What are statutory reserves? Statutory reserves, name itself is telling. Statutory means compulsory. There are some entity that operate in what we call some notified zones, like free trade zones, correct? So, such entities are pressurized by the law or compelled by the government that you have to create some reserves known as statutory reserves. So, statutory reserves are created under some foundation, under some compulsion, under some statutory guidelines. As far as statutory reserves are concerned, one is known as export profit surplus. Export profit surplus. Export profit surplus. Investment allowance reserve. Investment allowance reserves. Investment allowance reserve. Then development rebate reserve, if you want to write, development rebate reserve. Development rebate reserve, correct? Now, what is the accounting treatment? The accounting treatment is similar to the one which I just told you. You will transfer to the credit side of shareholders account. Credit side of shareholders account. Correct? So, as far as reserves are concerned, so you are very well aware of the treatment now. A specific reserve will be transferred to the credit side of realization account, but free reserves and statutory reserve will be transferred to the credit side of equity shareholder account, or simply shareholders account I have written. Now, besides liability and reserves, towards the liability side, what we come across, correct? We come across share capital only, nothing else. So, next item is share capital. As far as share capital is concerned, I need not require to tell you what will be the treatment. The share capital will be transferred to the credit side of shareholder account. You will simply take it to the credit side of shareholders account. This is how you are going to close the asset and liability side. Once your asset and liability side is closed, then under the third step, what you are going to do? The third step deals with purchase consideration. What we mean by purchase consideration? What we mean by purchase consideration? When other entity will take over your business, quite obviously other entity is going to give you some amount to purchase your business. Correct? You are not going to sell your business free of cost. You are going to charge something from the purchasing company. The amount which you are going to receive against the sale of your business is known as purchase consideration, or the amount which will be paid by the purchasing company to the vendor company, that is known as purchase consideration for taking over the business. So, purchase consideration, you are the vendor company, you are going to receive the purchase consideration. But first of all, you will have to pass an entry like this: purchasing company account debit, purchasing company account debit, purchasing company account debit to realization account. To realization account. You will pass this entry on the date when agreement takes place, when everything is clear, when purchasing company commits that we are going to purchase your business. purchasing company will immediately not what we call discharge the purchase consideration. First of all, agreement will take place. So on the date of agreement, when you are sure that you are going to receive the amount from the purchasing company, even though you haven't received the amount, but you are sure that now you are supposed to receive some amount from the purchasing company, you are going to debit the purchasing company account, because now you will consider them as your debtor, and it is a gain to you because you are going to receive some amount, you are going to credit the realization account. After some time, you will receive the amount of purchase consideration. When you are going to receive the purchase consideration, because other entity is a company, correct? Other entity is the company, and the company is taking your company. So because other entity happens to be a company form of business, so it may discharge the consideration either by paying cash or by paying some, or by issuing some shares. That means the purchase consideration can be discharged by purchasing company by way of cash, or through what we call issuance of the shares, or even debentures. So purchasing company will give you some amount, whatever amount, and in whatever manner you receive, you are going to debit it. For example, let us say some portion you are receiving in cash. You are going to simply debit cash account. Let us say some portion of the purchase consideration you are receiving by way of shares. So you are going to write here shares in purchasing company account. Shares in purchasing company account. You are going to debit shares in purchasing company account. Correct? So, and let us say you are receiving some debentures, you can debit the debentures in purchasing company account. So in whatever form you are going to receive the payment, you simply debit it. And because you are receiving these payment from the purchasing company, obviously you are going to credit the purchasing company. So you will write purchasing company. So in this manner, the purchasing company account will get closed. And whatever amount you have received in the form of cash, you are going to take it to the debit side of the cash. And besides cash, whatever you have received, you are simply going to take it to the debit side of shareholders account. That I will explain when I am going to take the what we call practical portion. Then, after the purchase consideration, the next step is now assets not taken over. Assets not taken over but sold. As I told you, all the assets will be transferred to the credit side of realization account, whether taken over or not. That means all the assets have already been transferred to the credit side of realization account. Now, if some of those assets might not have been taken over, obviously vendor company will try to sell those assets. So if there is any asset which is not taken over but sold, in that case you are going to write an entry, cash account debit to realization account. Cash account debit to realization account. So if there is any asset which hasn't been taken over but sold out, in that case entry will be like this, cash account debit to realization account. And similarly, there may be a liability which might not have been taken over. So, liabilities not taken over. Liability not taken over. But I have already told you, all the liability, whether taken over or not, are posted to the credit side of realization account. So all the liability you must have posted to the credit side of realization account already. Now, out of those liability, if any particular liability is not taken over, then it is the duty of the vendor company to pay off that particular liability. Because if that liability is not taken over, then it is the duty of the vendor company. Correct? Now it is your duty, because you are doing the accounting in the books of vendor company. You are the accountant of vendor company. So it is your duty to pay off that particular liability. So your entry will be realization account debit to cash account. Realization account debit to cash account. This is how you are going to pass this entry. Correct? And then last point is with respect to liquidation expenses. Liquidation expenses. Correct? Now your business is closed. In order to close the business, some legal things have to be met. Some various other expenses may have to be incurred. So that means some expenses take place. It is also known as cost of liquidation. Now it is important, if liquidation expenses are borne by vendor company, that means your company is getting closed. If liquidation expenses are borne by vendor company, so in that case, you are going to pass a very simple entry, realization account debit to cash account. Very simple, realization account debit to cash account, correct? This is the entry which you are going to pass if liquidation expenses are borne by vendor company. However, sometime purchasing company agree to bear the liquidation expenses. So, if liquidation expenses are borne by purchasing company, then we are not going to pass any entry. Vendor company will not pass any entry. In this case, entry will be passed in the books of purchasing company. Entry will be passed in the books of purchasing company. In the books of purchasing company. Is it clear to you? Now, obviously the purchasing company will pass the entry expenses account debit to cash account. So importantly, if expenses are borne by purchasing company, then vendor company is not going to pass any entry. If vendor company himself, or rather itself, will bear the expenses, then only it will pass the entry, and entry is very simple. After this, all you have to do is close your realization account. Close realization account. You will close your realization account. Remember one thing, the purchasing company account must have already closed. Correct? The moment you are going to receive the purchase consideration, the purchasing company account will automatically get closed. So in the last step, first of all, you will close the realization account. Whatever profit or loss is there, you are going to transfer it to equity shareholder account. And then you are going to close your shareholders account or equity shareholders account, whatever it is. And then finally, cash. Before that, actually, I told equity shareholder account. Just let me see. After the realization account, what you do actually, you prepare cash account and close it. Now, whatever balance in cash account is there, that balance will be posted to the shareholders account. I've already told you whatever result of realization account will be there, you post it to the shareholder account. Similarly, then you close cash account, whatever balance is there, you post it to shareholders account. And finally, your shareholder account will automatically get closed. If it automatically gets closed, that means whatever you have done, that is absolutely correct. And there is no room for any mistake. So this is how the accounting will be done. Is it clear to you? So first of all, we have to actually close the asset side, then liability side. We should be very well versed with all these terms, liability, reserves, and you need to understand that reserves are of three types: specific, free reserve, and statutory reserves. Correct? So what will be their postings? So that you need to take into account. So once you are become thorough with it, then it will become almost like a walk in the park. Correct, to solve the question. Obviously, in the next session, you will realize that how easy it is. So, obviously, for this particular session, it is enough, and in the next session, we'll meet you, and obviously over there, we are going to do some practical, and then this point will become much more clearer to you.